Before we begin, please remember that I am not a financial advisor, and this video is for educational and informational purposes only. The information presented here is not a substitute for professional financial advice. Always consult with a qualified and licensed professional before making any financial decisions, especially one as significant as a reverse mortgage. My neighbor Carol thought she'd found the perfect solution. A retired teacher, 72 years old, living in the same beautiful home she and her late husband bought 40 years ago. The house was paid off, her one true asset, but property taxes were climbing, the roof needed work, and her fixed income was stretched thinner than a rubber band in a hurricane. Then she saw the commercial. A friendly, familiar celebrity, smiling, talking about a government-insured program that lets you tap into your home's equity, tax-free, with no monthly mortgage payments. Sounded like a miracle. A reverse mortgage. It was supposed to be her golden ticket to a worry-free retirement, a way to finally breathe. Instead, it became a nightmare that nearly cost her everything. The house, her memories, her peace of mind. And the worst part? She never saw it coming. You've seen the commercials too. They run during the day, targeting seniors with a promise that sounds almost too good to be true. Access the wealth you've built up in your home. Eliminate your monthly mortgage payment. Live your golden years with financial freedom. They paint a picture of security, of vacations, of helping your grandkids with college. What they don't show you is the fine print. They don't talk about the astronomical fees, the compounding interest that grows like a weed in the dark, or the complex rules that can trigger a foreclosure and force you or your spouse out of your own home. This video is your defense. It's your shield against the slick marketing and the half-truths. Over the next several minutes, we are going to pull back the curtain on the reverse mortgage industry. I'm not just going to tell you they're risky. I'm going to show you how they're risky. We will dissect the 3 silent killers of a reverse mortgage: the equity evaporation machine, the spouse eviction trap, and the default domino effect. By the end of this presentation, you will understand the hidden mechanics of these loans better than 99% of the homeowners who sign on the dotted line. You will be able to spot the red flags a mile away, and you will be armed with the knowledge to protect your single greatest asset, your home. So let's start with the biggest, most dangerous misconception of them all. The line they repeat over and over again. You always retain ownership of your home. On the surface, it's technically true. Your name stays on the deed. But in reality, from the moment you sign that paperwork, the nature of your ownership changes fundamentally. You are essentially transforming your home from a solid asset, a pillar of wealth, into a melting ice cube of equity. You've invited a lender to take a seat at your kitchen table, and every single day they take a small scoop. Here's what's really happening. A reverse mortgage is a type of loan called a negative amortization loan. That's a fancy financial term for a very simple and very scary concept. Instead of you paying down the loan balance each month, the loan balance grows. Gets bigger. Every single month. Think about a regular mortgage. You pay principal and interest, and over 30 years your loan balance shrinks to zero. You build equity. A reverse mortgage does the exact opposite. It's a debt that grows, not shrinks. So where does this growth come from? First, there's the interest. You're not paying it monthly, so it gets tacked onto your loan balance. And the next month, you're charged interest on the new higher balance. It's compounding interest working against you, in the worst possible way. Second, there are the fees. And oh, the fees. The upfront costs for a reverse mortgage can be staggering. We're talking about origination fees that can run into the thousands, closing costs just like a regular mortgage, and a mandatory mortgage insurance premium, or MIP. This insurance, which primarily protects the lender, not you, requires a massive upfront payment, often 2% of your home's appraised value, plus an annual premium that also gets added to your loan balance. Let's put some real numbers on this to see the equity evaporation machine in action. Imagine your home is worth $400,000 and it's fully paid off. You're 65 and you decide to take out a HECM, the most common type of reverse mortgage. Let's say you get a lump sum of $150,000 to pay off some bills and create a cash cushion. Right off the bat, thousands of dollars are skimmed off the top for closing costs and that upfront mortgage insurance premium. So you might only see about $140,000 of that money. But your starting loan balance isn't $140,000. It's the full $150,000. Now the clock starts ticking. Let's assume a 5% interest rate. The first year, about $7,500 in interest is added to your balance. Plus, the annual mortgage insurance premium is added. Plus, monthly servicing fees are added. By the end of year 1, your loan balance might have ballooned to nearly $160,000. You've only been in the loan for 12 months, and you already owe $20,000 more than the cash you actually received. Meanwhile, you're not making any payments. The balance just keeps climbing, silently, relentlessly, eating away at the equity you spent a lifetime building. Fast forward 10 years. You're 75. That initial $150,000 loan, thanks to the magic of compounding interest and fees, could now easily be a $250,000 or even $275,000 debt. If your home's value has stayed flat or only grown modestly, you've effectively lost over $100,000 of your own wealth to the bank. It vanished. That's the equity evaporation machine. It's designed to transfer the wealth from your pocket to the lender's pocket over time. The commercials sell you the dream of using your equity. The reality is that the loan itself is structured to consume that equity as quickly as possible. This is the first and most fundamental risk. You are putting your home on a conveyor belt, and that belt is moving in one direction, towards the lender. And the longer you live in the home, the faster that conveyor belt moves, and the less equity you and your heirs are left with. You might start with a home that's 100% yours, but 5, 10, 15 years down the line, the bank could effectively own more of it than you do. You're living in a house that's slowly being hollowed out, financially speaking. This leads to a critical problem that traps so many seniors. What happens when you need to sell? Maybe you need to move into an assisted living facility, or you want to move closer to your kids. You thought you had $400,000 in home value to work with, but after a decade with the reverse mortgage, you discover you only have $125,000 left after paying back the bloated loan balance. The financial flexibility you thought you were gaining was an illusion. The loan didn't give you freedom. It put a lien on your future, a lien that grew larger every single day. Now this slow, silent erosion of wealth is bad enough. But it's what happens when this financial pressure meets the realities of life that the real nightmare begins. This is where Carol's story takes a dark turn, because the equity evaporation machine is just the engine of the trap. The real danger lies in the triggers that can cause the whole thing to snap shut, unexpectedly and catastrophically. The triggers that the lenders don't exactly highlight in their glossy brochures. For Carol, it all started with something that seems completely unrelated to her loan, something every homeowner faces eventually. A major, unexpected home repair. It was a storm, a once-in-a-decade downpour that turned her quiet street into a shallow river. For 2 days, the rain didn't stop. On the third morning, Carol woke up not to the sound of her alarm clock, but to the rhythmic drip, drip, drip of water. She found it in the living room. A dark, ugly stain the size of a dinner plate had bloomed on her ceiling. And from its center, water was steadily plopping onto the hardwood floor her husband had installed with his own 2 hands 30 years ago. The roofer's estimate felt like a physical blow. $22,000. The storm had done more than just loosen a few shingles. It had compromised the underlying structure. It wasn't a patch job. It was a full replacement. $22,000. To Carol, living on her late husband's pension and Social Security, it might as well have been $1 million. Her savings account held just under $5,000, an emergency fund she guarded fiercely for medical bills or a new transmission for her 10-year-old car. Wiping it out wouldn't even cover a quarter of the cost. For weeks, she lived in a state of quiet panic. She put a bucket under the leak. She called other roofers hoping for a miracle, but their quotes were all in the same terrifying ballpark. The stain on the ceiling grew larger, a constant, mocking reminder of a problem she couldn't solve. Her home, the place that was supposed to be her sanctuary, her fortress of solitude, had suddenly become the source of her greatest anxiety. She couldn't sleep. She barely ate. The thought of taking on a traditional home equity loan, with its mandatory monthly payments, was impossible. Her budget was already stretched to its breaking point. Where would an extra $400 or $500 a month come from? That's when she saw the commercial. It was late one afternoon, a friendly, silver-haired celebrity spokesperson sitting in a comfortable-looking living room, much like her own. He wasn't talking about a loan. He was talking about a government-insured program for seniors. He spoke about financial freedom, about peace of mind. He used phrases like access the wealth you've built and stay in the home you love. He never once said the word debt. He said, "You still own your home." And the magic words that caught Carol's ear, "no monthly mortgage payments," felt like an answer to a prayer. The next day, she called the number on the screen. The man who came to her house a few days later was professional, kind, and incredibly reassuring. He sat at her dining room table, the one where she'd shared countless meals with her family, and laid out a beautiful full-color brochure. He called it a HECM, a home equity conversion mortgage. He explained that because she was over 62 and had significant equity in her home, it was nearly paid off, she was a perfect candidate. He explained she could take the money as a lump sum, enough to fix the roof and have a substantial cushion left over, or she could take it as a line of credit, or even as a monthly payment to supplement her income. The choice was hers. He walked her through the numbers, and to her tired, worried mind it all sounded perfect. The interest rates, the origination fees, the mortgage insurance premium, he mentioned them of course, but framed them not as costs, but as standard procedures, necessary safeguards for this wonderful government program. They were just numbers on a page that would be rolled into the loan balance. She wouldn't have to pay for them out of pocket. In fact, she wouldn't have to pay anything out of pocket. Ever. As long as she lived in her home, she would never have to make a single monthly payment. Seemed too good to be true. He assured her it wasn't. "Carol," he said with a warm fatherly smile, "you worked your whole life for this home. You've poured your sweat and your savings into it. This isn't our money. It's your money. We're just helping you access it when you need it most." She signed the papers. A few weeks later, a check arrived. The feeling of relief was overwhelming, like coming up for air after being held underwater. She called the roofer that same day. Within 2 weeks, she had a brand new roof, guaranteed for 30 years. The water-stained ceiling was repaired and repainted. The bucket was gone. For the first time in months, Carol slept through the night. She paid off a high-interest credit card. She took her grandkids out for a special dinner. She even bought the new set of tires she desperately needed for her car. The reverse mortgage wasn't a loan, it was a lifeline. It had saved her. What Carol didn't focus on, what was buried deep in the mountain of paperwork she had signed, were the ongoing obligations. The salesman had mentioned them, but only in passing, like a minor detail. "Of course," he'd said, "you're still the homeowner, so you're still responsible for the little things like property taxes, homeowners insurance, and basic upkeep." It seemed so obvious, so logical, that her mind barely registered it as a condition of the loan. Of course she would pay her taxes and insurance. She always had. It was what a responsible homeowner does. She didn't understand that these little things were not just suggestions. They were ironclad, non-negotiable covenants of the loan agreement. They were the triggers. In the world of reverse mortgages, there are 3 pillars of default, 3 ways you can lose your home without ever missing a single monthly payment you were promised you'd never have to make. Failure to pay property taxes, failure to maintain homeowners insurance, and failure to maintain the property to the lender's standards. For the first year, everything was fine. Carol enjoyed her newfound financial stability. The roof was perfect. The house was secure. But as the seasons changed, something else was quietly changing. The cost of living. Property taxes in her area were reassessed, and her bill went up by nearly 20%. Then, after a season of wildfires on the other side of the country, her homeowner's insurance premium shot up by 30%. Suddenly, these 2 annual bills, which she used to pay out of her savings, were becoming a serious burden again. The cushion she had from the reverse mortgage was dwindling faster than she'd anticipated. By the 2nd year, she was struggling. By the 3rd, she found herself making a choice. Pay the full, inflated property tax bill on time, or buy her heart medication and groceries for the next 2 months. She chose to live. She sent in a partial payment to the county tax assessor, figuring she'd catch up later. It was a small delay, she thought. A private matter between her and the county. She was wrong. It wasn't a private matter, because her reverse mortgage lender, the company that promised her she'd never have to worry about losing her home, was monitoring the county records. And they saw the delinquent payment. This single small act of financial survival had just tripped the first wire. It set in motion a cold automated process, a sequence of events that once started, is nearly impossible to stop. An official-looking envelope arrived a few weeks later. It wasn't a friendly reminder. It was a formal notice of default. John's hands trembled as he held the paper. Default. The word was an accusation, a judgment. Felt alien, wrong. They hadn't missed a mortgage payment in 40 years. They didn't even have a mortgage payment anymore. That was the whole point. This was supposed to be their reward, the fruit of a lifetime of hard work. Mary read the letter over his shoulder, her breath catching in her throat. It was dense with legal jargon, but the message was brutally clear. The loan was now considered due and payable. All of it. The full $150,000, plus interest and fees. "This is a mistake," Mary said, her voice thin. "We just have to call them. We'll explain. We'll pay the taxes. It's a simple misunderstanding." John grabbed the phone. He dialed the number on the letterhead, a number he'd never had to call before. The friendly, reassuring voice of the loan officer who had visited their home, the one who had praised their beautiful garden and told them they deserved this, was nowhere to be found. Instead, he was met with the sterile automated menu. "Press 1 for new inquiries. Press 2 for account information." After a labyrinth of choices and 15 minutes of grating hold music, a voice finally came on the line. It was flat, professional, and utterly devoid of empathy. John explained the situation, the missed tax payment, the confusion, their intention to pay it immediately. He waited for the person on the other end to say, "Oh, of course, Mr. Henderson. As long as you get that paid, we'll clear this right up." But that's not what they said. The representative on the phone, a man named Mark who sounded like he was reading from a script in a cubicle 1,000 miles away, said, "Sir, according to Section 7B of your home equity conversion mortgage agreement, failure to pay property taxes in a timely manner constitutes a maturity event." A maturity event. The phrase hung in the air, cold and clinical. John didn't remember hearing those words from the salesman. He remembered hearing peace of mind, financial freedom, stay in your home forever. A maturity event sounded like something that happens when a bond comes due, not something that rips your life apart. He asked, "What does that mean? A maturity event?" "It means the loan is now due in full, sir. You have 90 days from the date of the notice to satisfy the entire loan balance." The silence in the kitchen was deafening. The entire loan balance? For a $2,000 tax bill? It was like getting a life sentence for a parking ticket. "But we don't have that kind of money," John stammered. "If we had that kind of money, we never would have taken this loan in the first place. We can pay the taxes. We can pay the taxes right now." "I understand your position, sir," the voice replied, with no understanding in it at all. "However, the terms of the contract are clear. The default has triggered an acceleration of the loan. The only way to cure the default is to repay the loan in its entirety. This is the hidden switch, the trapdoor built into the very foundation of so many of these agreements. It's not just about dying or selling the house. The lender, whose primary interest is protecting their collateral, your home, writes in a series of tripwires. They call them borrower obligations. Fail to pay your property taxes and you've tripped the wire. Why? Because if you don't pay your taxes, the county can put a lien on your home that is superior to the lender's lien. The county gets paid first. The lender will not allow that. Fail to maintain your homeowner's insurance, and you've tripped another wire. A fire, a flood, a storm could wipe out the value of their collateral, leaving them with nothing. So, if your policy lapses for even a day, it can be grounds for a maturity event. Fail to maintain the property to their standards? That's a more subjective, but equally dangerous tripwire. A leaky roof, a crumbling foundation, anything they deem to be diminishing the value of the home, can trigger a default. Even leaving your home for an extended period can be the trigger. If you need to move into a nursing home or an assisted living facility for more than 12 consecutive months, the loan can be called due. The home is no longer your principal residence, and the terms have been broken. John and Mary had no idea. They, like millions of others, believed the promise that they would never have to make a payment and could live in their home until they died. They didn't realize they were signing up for a new set of rules, a rigid contract where the lender held all the power, and the slightest misstep could lead to catastrophe. They had traded one kind of financial stress for another, far more lethal kind. Over the next few weeks, they lived in a fog of panic. They called the servicer again and again, each time getting a different person, each time getting the same cold, scripted response. They were no longer Mr. and Mrs. Henderson, valued clients. They were an account number, file, a non-performing asset. They scraped together the $2,000 for the taxes and sent it to the county. They even sent proof of payment to the loan servicer, a desperate plea for reason. The response was another letter. It acknowledged receipt of their correspondence but stated that their account remains in default, and that foreclosure proceedings have been initiated. Foreclosure, the word they had spent their entire adult lives working to avoid. It was the ultimate symbol of failure, of losing everything. And it was happening to them not because they were destitute, not because they'd been irresponsible for years, But because of one mistake, one oversight, amplified by the merciless fine print of a contract they had never truly understood, they sat at their kitchen table, the same table where they'd raised their children, celebrated birthdays, and signed the reverse mortgage papers that were supposed to be their salvation. Now that stack of papers felt like a time bomb that had just gone off. They looked at the numbers. The loan balance wasn't just the $150,000 they had access to. It was more. The upfront mortgage insurance premium, the origination fees, the monthly servicing fees, and the compounding interest had all been added to the balance. The amount they owed was now closer to $170,000. Where were they supposed to get that kind of money in less than 60 days? They couldn't get a traditional loan. Their income was too low. That's why they got the reverse mortgage. Selling the house was the only option, but a forced, panic sale under the threat of foreclosure would mean accepting a lowball offer, leaving them with almost nothing after the loan was paid off. They would be homeless with only a few $1,000s to their name, at 75 years old. The dream of aging in place, of leaving a legacy for their children, was evaporating before their eyes. The house was no longer a home. It had become a prison, its walls closing in. Every creak of the floorboards, every rattle of the windows sounded like a judgment. They had been sold a solution, but they had been delivered a nightmare. And the worst part was the chilling realization that the system wasn't broken. It was working exactly as it was designed. The contract they signed was being executed, line by merciless line. The clock was ticking, and the only sound they could hear was the rustle of foreclosure papers being drawn up, miles away, by someone who didn't even know their name. That rustling sound was the first domino. For John, sitting alone in the quiet house, it was an imagined noise that quickly became a deafening roar in his mind. Foreclosure. The word didn't make sense. This was their home. They had a reverse mortgage. It was supposed to be the solution, the safety net that caught them in their final years. It wasn't supposed to become the trapdoor. His first call was to the lender, the 1-800 number on a statement he found in Mary's pristine filing cabinet. He expected a person, a voice of reason, maybe even sympathy. What he got was a labyrinth of automated menus, each press of a button leading him deeper into a cold digital maze. When he finally reached a human being, the conversation was a masterclass in corporate detachment. He explained the situation, his voice cracking as he mentioned Mary's name. He told them he was the surviving spouse, that the home was his. There must be a mistake. The agent on the other end of the line paused. John could hear the clacking of a keyboard, the sound of his life being reduced to a data point on a screen. "Sir," the voice began, devoid of any warmth, "I'm showing a delinquency on the account. The loan has been accelerated." "Delinquency? What are you talking about? We never missed a payment because we didn't have payments. That's the whole point of a reverse mortgage." Another pause. More clacking. "Sir, the terms of the agreement state that the borrower is responsible for all property taxes, homeowners insurance, and general upkeep of the home. Our records indicate the county property taxes for the last year are unpaid. As per the contract, this constitutes a default. The full loan balance is now due and payable." The full balance. John's mind reeled. A number so large it felt fictional. It was more than the house was even worth now. "Due? How can it be due? I don't have that kind of money. Nobody does. It was just an oversight. Mary, she was sick. We were at the hospital. I can pay the taxes now. I can fix this." "Sir, once the loan is accelerated, the only way to cure the default is to pay the balance in full. A notice of intent to foreclose has been mailed to the property address. You will have a set period of time to respond." And with a curt, "Thank you for calling," the line went dead. John sat there, the receiver still pressed to his ear, listening to the dial tone. He was adrift in a sea of confusion and fear. He had been so focused on the big obvious trigger, the death of the last borrower, that he completely missed the tripwires laid all around him. He stumbled back to Mary's filing cabinet, his hands shaking as he pulled out the thick folder labeled reverse mortgage. He ripped open the binding and spread the documents across the dining room table where he and Mary had shared thousands of meals. And there it was, buried deep in pages of dense legal jargon, under a subheading titled Borrower's Obligations, was the clause. It was an entire section dedicated not to death but to life. It was a list of duties, of responsibilities he and Mary had sworn to uphold for the life of the loan. And they had failed. This is the part of the reverse mortgage story that the commercials never show you. They sell you a dream of financial freedom, of tapping your home's equity to live a golden retirement. But what they don't tell you, what they whisper in the fine print, is that you are entering into a strict business partnership with your lender. And your lender has one priority: protecting their investment, your home. To do that, they embed a series of non-negotiable conditions into the contract. Violating any one of them can trigger a default and ultimately foreclosure long before you or your spouse passes away. Let's break down these hidden triggers, because understanding them is the only defense you have. The first and most common is the one that ensnared John and Mary: failure to pay property taxes and homeowners insurance. They call this a T&I default, and it is the silent killer of reverse mortgages. For decades, you may have had these costs bundled into your monthly mortgage payment through an escrow account. Your lender paid them for you automatically. You barely had to think about it. But with a reverse mortgage, there are no monthly payments. That escrow account is gone. Suddenly, you are responsible for paying these bills directly, often in large, lump sum payments once or twice a year. A tax bill for thousands of dollars can arrive like a thunderclap for a senior on a fixed income. A sudden illness, a period of confusion, a simple oversight like the one John and Mary made, and the clock starts ticking. The lender will often step in and pay the delinquent taxes or insurance to protect their interest, but they don't do it out of kindness. They tack that amount, plus fees and interest, onto your loan balance. And if you can't immediately reimburse them, they can and often will initiate foreclosure. The second hidden trigger is failure to maintain the property. This is tragically vague and dangerously subjective. Your loan documents state that the home must be kept in good repair. But what does that mean? To you, a peeling paint job or a few cracked shingles on the roof might be a weekend project you'll get to eventually. To your lender, who may conduct periodic inspections or even just use a satellite service to look at your roof, it can be seen as a breach of contract. They see it as you letting their collateral, their investment, degrade. They can send you a letter demanding immediate repairs. If you can't afford a new roof or a major plumbing fix on your limited income, they have the right to call the entire loan due. Your home, which was supposed to be your castle, suddenly has a landlord who can demand expensive upgrades you simply cannot afford. The third trigger is the occupancy rule. A reverse mortgage is only valid as long as the home is your primary residence. If you move out for more than 12 consecutive months, you are in default. Now, this makes sense on the surface, but think about the realities of aging. What if you have a medical crisis that requires a long-term stay in a rehabilitation facility or a nursing home? What if you need to move in with a child for a year to receive intensive care? Even if you have every intention of returning home, if that absence stretches past the 12-month mark, the lender can legally foreclose. The very health crisis that makes you most vulnerable could be the event that costs you your home. The safety net disappears the moment you need it most. John stared at the paperwork, his eyes blurring with tears. It was all there in black and white. He saw the tax bill from the county, tucked into a different folder. It had arrived during the last few weeks of Mary's life, a time of chaos and heartbreak. It had been set aside, forgotten in the crushing weight of grief and hospital visits. A single overlooked piece of mail was about to cost him everything. The memories, the security, the final promise he had made to his wife that he would be okay in their home. He felt a profound sense of shame. How could he have been so foolish? He had read the brochures, he had sat through the counseling session required by law. But all he had heard was what he wanted to hear. No monthly payments, stay in your home, peace of mind. He hadn't truly listened for the caveats, the conditions, the clauses written by lawyers to protect the bank, not the borrower. He thought of his children. He and Mary had always told them, "Don't worry about us. We've got this handled. The house is taken care of." They believed the reverse mortgage was a responsible choice, a way to avoid being a burden on their kids. Now, that responsible choice had morphed into a monster. Not only was there no inheritance left for them, the loan balance had already consumed every last cent of equity, but he was about to be homeless. He was about to become the one thing he never wanted to be, a burden. He picked up the phone, his hand trembling, to make the hardest call of his life. He had to tell his kids that the family home, the place where they grew up, was being taken away, and it was all his fault. The silence on the other end of the line was heavier than any words could ever be. His daughter, Sarah, finally spoke, her voice a fragile whisper. "Dad? What do you mean, taken away? The house? I don't understand." Arthur squeezed his eyes shut, the image of his late wife, Eleanor, tending her rose bushes in the front yard flashing in his mind. He had to force the words out, each one a betrayal of her memory, of the life they built within those walls. The bank, honey. The reverse mortgage. They called the loan due. Sarah's confusion quickly turned to a sharp, protective anger. Due? Why? You've been paying the taxes, the insurance, we made sure of that. You haven't missed a single payment because there are no payments. That was the whole point, right? She was right. That was the sales pitch. Live in your home payment-free until you pass away. It sounded so simple, so safe. A perfect solution for a widower on a fixed income. But the devil, as Arthur was learning with crushing certainty, was always in the fine print. The fine print he'd been too grief-stricken and too trusting to scrutinize a decade ago. It's because I moved out, Sarah, he confessed, the shame burning in his voice. When I went into the assisted living facility, I've been here more than 12 months. The contract says, if the borrower is no longer living in the home as their principal residence for 12 consecutive months, the loan becomes due and payable. Due and payable. 3 words that had just detonated his entire world. 3 words that were about to erase 50 years of memories. This is one of the most misunderstood triggers of a reverse mortgage default, and it's a nightmare scenario that plays out in quiet suburban homes across the country. It's not about missing a payment in the traditional sense. It's about violating a residency clause that many homeowners forget even exists. For Arthur, the move to assisted living wasn't a choice. It was a necessity after his fall. He thought he was doing the responsible thing, ensuring he wouldn't be a burden on his children. Instead, he had inadvertently lit the fuse on a financial time bomb. The loan servicer doesn't see a man who needs care. They see a clause in a contract. They see an asset that is no longer occupied by the borrower. An automated system flags the account. A letter is generated. And just like that, the clock starts ticking. The family is typically given a short window, often just 30 days to declare their intentions, and 6 months to pay the loan back in full. Pay it back. How? The entire reason Arthur took out the loan was because his savings were gone. His children, Sarah and her brother, had their own mortgages, their own kids' college funds, their own lives. They didn't have a spare $300,000 lying around to satisfy the bank. The only option, the one the bank presents as the neat and tidy solution, is to sell the house. Sell the home that held every birthday party, every Christmas morning, every scraped knee and high school graduation photo. Sell it to pay back a loan that was supposed to provide peace of mind. But as Sarah started making frantic calls to the loan servicer, a far more sinister detail began to emerge. A detail that turned a terrible situation into a catastrophic one. The representative on the phone was polite but firm. She asked a simple question that made Sarah's blood run cold. Was your mother, Eleanor, listed as a co-borrower on the loan? Sarah paused. She didn't know. Why would she? It was her parents' finances. I think so. She lived there her whole life. The representative's tone didn't change, but the implication of her next words was devastating. I'm not showing an Eleanor Miller as a co-borrower. I only have Arthur Miller listed. That means she was considered a non-borrowing spouse. A non-borrowing spouse. This is a term that should send a shiver down the spine of anyone considering a reverse mortgage. Back when Arthur and Eleanor took out the loan, the rules were different and frankly far more brutal. To qualify for the loan or to maximize the payout, sometimes only one spouse would be listed as the borrower. This often happened if one spouse was younger than the minimum qualifying age of 62. In Arthur and Eleanor's case, Eleanor was only 60 at the time. The loan officer had presented it as a clever workaround. We'll just put Arthur on the loan, he'd said with a reassuring smile. He qualifies and you'll get a larger lump sum. It's just paperwork. What he didn't explain, or what he glossed over in a mountain of other documents, was the terrifying consequence of that paperwork. For loans originated before 2014, the rule was ironclad. When the sole borrower on the loan died or permanently left the home, the loan was due. Period. It didn't matter if their husband or wife had lived there for 50 years. The non-borrowing spouse had no automatic right to remain in the home. They were, in the cold eyes of the contract, just another resident in a house that was now in foreclosure. Thousands of seniors, mostly widows, were thrown out of their homes because of this cruel loophole. They lost their spouse, and then in the deepest moments of their grief, they lost their home. While the FHA implemented new protections for non-borrowing spouses in 2014, those protections did not automatically apply retroactively. For people like Arthur, who took out their loan before the change, the old unforgiving rules were still in effect. Even if Eleanor were still alive when Arthur moved into assisted living, she would have received that same letter. She would have been facing eviction from the home she'd shared with her husband for half a century. The thought was so horrific it made Arthur physically ill. He had not only failed his children, he realized, he had unknowingly put Eleanor in the crosshairs of financial ruin. It was a mercy she never had to find out. But his residency wasn't the only trigger. People lose their homes to reverse mortgage foreclosures for reasons that seem almost trivial. The most common is failing to pay property taxes or homeowners insurance. The lender will often advance money to cover these costs to protect their investment, adding that amount, plus interest and fees, to the loan balance. But if the homeowner can't reimburse them, foreclosure proceedings begin. It's a vicious cycle. The person took out the loan because they were cash poor, and now they're losing their home because they are still cash poor. Another trigger, failing to maintain the property. If the home falls into significant disrepair, the lender can claim the homeowner is jeopardizing the value of the collateral, the house, and call the loan due. Imagine receiving a foreclosure notice because you couldn't afford to fix a leaky roof. For Arthur and his family, the trap had been sprung. Sarah spent days on the phone, navigating automated menus and talking to indifferent agents who kept repeating the same script. The terms of the loan were triggered. The balance is due. She asked for more time for a modification, for any kind of solution other than selling her childhood home. The answer was always a polite, bureaucratic no. The servicer wasn't a person, it was a system. And the system was designed to do one thing: recoup its investment. Finally defeated, Sarah asked for the official payoff statement. She needed to see the numbers in black and white. She knew her dad had taken out about $150,000 over the first few years. The house was probably worth around $300,000 now. So they'd have to sell, pay back the loan, and maybe her dad would have a little left over. It was heartbreaking, but it was manageable. A few days later, a certified letter arrived. Sarah opened it with a sense of dread, her eyes scanning past the legal jargon to find the number, the payoff amount. And when she saw it, she felt the floor drop out from under her. It wasn't $150,000. It wasn't even $200,000. The number was impossible. It was more than the house was even worth. How could this be? Where did this monstrous number come from? The answer wasn't in the fine print. It wasn't hidden in some complex legal clause she'd need a magnifying glass to read. It was right there on the statement, broken down into 3 innocent-sounding lines. And these 3 lines were the architecture of her financial ruin. The first line was principal balance. This was the money she had actually received. Over the decade, between the initial lump sum to pay off her old mortgage and the small monthly checks she'd relied on for groceries and utilities, it added up to about $140,000. That number, while large, made sense. It was tangible. It was the money that fixed the roof, paid for her prescriptions, and kept the lights on. It was the money that had bought her peace of mind. But peace of mind, she was learning, came with a price tag she never saw. The second line was accrued interest. This is where the math started to get fuzzy and then frightening. Barbara, like most of us, understood simple interest. You borrow $100 at 5%, you owe $105 at the end of the year. But a reverse mortgage isn't simple. The interest wasn't being calculated on a loan she was paying down. It was being calculated on a loan that was actively growing. Every single month, interest was charged on her $140,000 principal. But she wasn't making any payments. So what happened to that interest charge? It didn't just vanish. It was tacked right back onto the loan balance. The next month, she was charged interest on the original principal plus the interest from the month before. It's a concept called compounding, and in a savings account, it's your best friend. In a reverse mortgage, it's a predator. Think of it like a credit card you never ever pay. Imagine you charge $1,000. The next month, you have a $20 interest charge. Now you owe $1,020. The month after that, the interest isn't calculated on the original $1,000. It's calculated on the new, higher balance. It's a debt that feeds on itself, a monster that grows larger with every passing day, even if you never spend another dime. For 10 years, this monster had been silently feeding on Barbara's home equity. The interest had piled on top of interest, which piled on top of more interest, creating a financial avalanche. This line item alone added nearly $90,000 to her debt. She was now at $230,000, already far more than she imagined, but it still didn't account for the terrifying total at the bottom of the page. That's because the real killer, the secret ingredient in this toxic stew, was the third line. It was a line item most borrowers glance over, thinking it's for their own protection. It was called the mortgage insurance premium, or MIP. And this is one of the most misunderstood and most dangerous parts of a government-insured HECM reverse mortgage. When the loan officer mentioned FHA insured, it sounded like a good thing. It sounded safe, a guarantee from the government. Barbara assumed it was insurance to protect her home. It wasn't. The mortgage insurance premium does not protect the homeowner. It protects the lender. It's a guarantee that if the loan balance grows to be more than the home is worth when it's sold, the lender will get all their money back. The FHA insurance fund will cover the difference. It's the lender's safety net, not yours. And you, the homeowner, are forced to pay for it. But how you pay is the truly insidious part. There's an upfront premium, which is usually just rolled into the loan balance at the very beginning. But there's also an annual premium. And here's the devastating catch. That annual premium isn't calculated on the money you actually borrowed. It's calculated on the entire outstanding loan balance. Let that sink in. Every year, Barbara was being charged an insurance premium based on her principal, plus all the compounding interest, plus all the previous insurance charges that had already been added to the balance. It's a triple compounding nightmare. The principal is growing from interest. The interest is growing because the principal is growing. And the insurance premium is growing because both the principal and the interest are growing. It's a feedback loop from hell, designed to systematically strip every last cent of equity out of a home and transfer it to the lender. This MIP was the silent partner in her loan, a partner who contributed nothing but took a bigger and bigger cut every single year. It was the reason her loan balance hadn't just grown, it had metastasized. It had ballooned at a rate that defied common sense, transforming her home from her greatest asset into her largest liability. This single line item, this insurance, had added over $100,000 to what she owed. Principal, $140,000. Accrued interest, $90,000. Accrued mortgage insurance, over $100,000. Suddenly, the monstrous number at the bottom of the page made a terrible kind of sense. $330,000. On a house now worth maybe $275,000 on a good day. This is the central brutal truth of a reverse mortgage that the commercials never show you. It's a product built on a concept called negative amortization. It's a fancy term for a simple, horrifying reality. Unlike a normal mortgage where every payment reduces your debt and builds your equity, a reverse mortgage is engineered to do the exact opposite. Your debt goes up, not down. Every single day. Your equity goes down, not up. Every single day. You aren't paying the loan. The loan is paying itself by consuming your house. The no monthly payments promise wasn't a gift. It was a trap. The payments were still being made. Interest, insurance, servicing fees. But instead of coming out of your bank account, they were being added to your debt silently, relentlessly, month after month, year after year. Barbara felt a wave of nausea. She thought back to the smiling loan officer, the glossy brochures promising a golden retirement and financial freedom. They sold her a dream, but they'd handed her a ticking time bomb. All those years she felt secure. She was actually living on borrowed time in a house that was no longer truly hers. It belonged to the bank, to the math, to the unstoppable engine of negative amortization. The feeling of betrayal was absolute. It was the chilling realization that the system she was told would protect her had been designed to fleece her. The government insurance wasn't for her. The appreciation of her home wasn't for her. It was all just fuel for the fire that was now consuming her life's work. And as she stared at that impossible number, another, more urgent question began to surface. This statement wasn't just a summary. It was a warning. Why were they sending this to her now with such an ominous tone? For 10 years, the statements had been routine, ignorable. But this one was different. This one felt like a prelude to something terrible. She scanned the document again, her eyes darting past the columns of figures, searching for a reason, for a trigger. And then she saw it. Tucked away in a separate box under the headline Loan Status was a single terrifying word she had never seen before on one of these statements. It was a word that made her blood run cold, because it meant the clock had just run out. The word was default. But how? She hadn't missed any payments. There were no payments to miss. She hadn't died. She hadn't moved. She had done everything she was told she had to do. So how, in God's name, could she be in default? The answer was buried in the fine print of a contract she hadn't looked at in years. A document filled with dense legal language designed to be impenetrable. But the letter in her hand was brutally simple. It wasn't written by lawyers for lawyers. It was written by a lender for a target. With a trembling hand, Mary dialed the number on the letterhead. Each ring felt like a hammer blow against her chest. When a voice finally answered, it was flat, devoid of any warmth. She explained who she was, her voice cracking as she read her loan number. She asked the question that was consuming her. Why am I in default? There was a pause, the sound of typing. Let me see, Mrs. Gable. Ah yes. Our records show your homeowner's insurance policy lapsed 3 months ago. Mary's mind went blank. Her insurance? What? No, that's impossible. I've been with the same company for 40 years. Our records show, the voice repeated with an infuriating calmness, that we sent you 2 notices regarding a failure to provide proof of an active policy. When we received no response, we were forced to purchase a policy on your behalf. You bought insurance for me? A sliver of relief quickly extinguished. Yes, it's called force-placed insurance, and the premium has been added to your loan balance. Mary felt a dizzying wave of confusion. But if you paid it, then why am I in default? Because, ma'am, the premium for the force-placed policy, which is significantly more expensive than a standard policy, caused your loan balance to exceed the principal limit. Furthermore, your county property taxes are also delinquent for the last 2 quarters. That amount has also been advanced by us and added to your loan balance. The failure to pay these property charges constitutes a default event, as per Section 4.2 of your loan agreement. Property charges. The words hung in the air. Taxes and insurance. Of course, for 40 years with her traditional mortgage, those costs had been bundled into her monthly payment. A little extra each month went into something called an escrow account, and the bank took care of paying the taxman and the insurance company. It was automatic. Invisible. When the reverse mortgage salesperson had gleefully told her no more monthly mortgage payments, Mary had assumed, as so many do, that this meant all the housing payments she was used to making were gone. She had never received a separate bill for property taxes in her life. It had always been handled. She didn't know who to pay or when or how. The notices the county sent probably looked like junk mail, and she tossed them, assuming the lender was taking care of it. The insurance was an even crueler twist. Her longtime agent had retired, the agency was sold, and in the confusion, a renewal notice had been mailed to an old P.O. box. A simple, correctable human error. But in the world of reverse mortgages, there is no room for human error. This is the single most common trap of a reverse mortgage. You are still and always will be responsible for paying your property taxes, your homeowner's insurance, and any HOA fees. If you fail to make even one of these payments, the lender can and often will pay it for you. But they don't do it out of kindness. They do it to protect their investment, your house. Then they add that amount plus fees to your loan balance. And here's the kicker. This act of paying your bills for you is what can trigger a default and start the foreclosure clock. It's a rescue that drowns you. Some lenders might offer something called a LISA, a life expectancy set-aside. Sounds helpful. They estimate how much your taxes and insurance will be over your expected lifetime, and they set aside a chunk of your own home equity to cover those bills. The problem is, it's just an estimate. Property taxes almost always go up. Insurance premiums skyrocket, especially in areas prone to floods, fires, or hurricanes. What happens when that set-aside money runs out 5 or 10 years down the road? You're suddenly on the hook for massive bills you haven't had to think about for a decade. And you're older, more vulnerable, and have less access to cash than ever before. The LISA isn't a safety net. For many, it's just a delayed action trap. Mary didn't have a LISA. Her loan was older, and she had needed every penny of equity she could get just to survive. So what do I do? She asked the disembodied voice on the phone, her own voice now a whisper. How do I fix this? You would need to cure the default, ma'am. That means you must repay the full amount we have advanced for your taxes and insurance, plus any associated fees. The total is $7,812.63. $7,000. It might as well have been $7 million. That was more money than she had seen in one place in 20 years. It was an impossible number. I don't have that kind of money, she stammered. Can't you just add it to the loan? Ma'am, adding it to the loan is what caused the default. Your balance has already exceeded the allowable limit. To cure the default, you must pay that amount out of pocket. You have 90 days from the date on the letter. But as Mary hung up the phone, her body shaking, she reread the letter. And she saw something else, another line item in the list of her failures. It wasn't just about the taxes and insurance. There was another reason listed for the default, one that felt even more sinister. It read, "Failure to maintain the property in accordance with FHA guidelines." She thought back. About a month ago, a polite young man had shown up at her door. He said he was from the loan servicer, just doing a routine property inspection. A standard procedure. He was charming, asked about her late husband, commented on her garden. He was only there for 15 minutes. He took a few pictures of the outside of the house and left. Mary hadn't thought twice about it. Now she understood. He wasn't there to be polite. He was an evidence collector. This is the second hidden trigger, the one that feels like a personal attack. Every reverse mortgage contract has a clause requiring you to maintain your home. Sounds reasonable, but maintain can be a dangerously subjective word. A patch of peeling paint, a cracked window pane, a loose shingle on the roof after a storm, a fence that's leaning a little. To you, it's your home with all its imperfections. To a lender, these can be violations of the agreement. They can use a photo of that peeling paint as justification to declare you in default, claiming you are letting their collateral, your home, fall into disrepair. They can demand you make immediate, costly repairs. If you can't afford to hire a contractor to paint the entire house or replace a section of the roof, they can, once again, declare you in default and start the foreclosure process. It's a loophole big enough to drive a moving truck through, and it allows lenders to weaponize the normal wear and tear of a lived-in home against the elderly homeowner. Mary looked out her kitchen window at the small patch of paint flaking near the windowsill, a project she was planning to get to this spring. She had just been handed a bill for nearly $8,000 that she couldn't pay, for expenses she didn't even know she was responsible for. And now she realized, with a cold dread washing over her, that the very character of her home, the gentle aging of the place she had lived in for half a century, was also being used as a weapon to take it all away. The 90-day clock wasn't just ticking. It was a countdown to eviction. The formal language of the letter, the cold printed words of the foreclosure notice, felt like a physical blow. 90 days. It wasn't a warning. It was a verdict. Maria sat at her kitchen table, the same table where she'd served 1,000 family dinners, and felt the foundation of her world crumble. For the first few days she did nothing. A paralysis of fear and shame took hold. How could she tell her children? How could she admit that the financial tool she'd chosen for security had become the instrument of her ruin? She had been a responsible homeowner her entire adult life. She paid her bills on time, never carried debt she couldn't handle. This felt like a stain on her character, a personal failure of catastrophic proportions. But as the first week bled into the second, a different feeling began to surface, pushing through the thick fog of despair. Anger. A slow-burning, righteous anger. They were not just taking her house. They were trying to take her dignity, her history, her legacy. She thought of Robert, of the promises they made to each other in this very home. She wouldn't let it go without a fight. Her first calls were to the loan servicer. She was met with the labyrinth of automated menus and hold music designed to grind a person's will into dust. When she finally reached a human, they were polite, detached, and utterly unhelpful. They spoke a different language, a corporate dialect of contractual obligations, breach of terms, and acceleration of the loan. They confirmed the default was due to failure to maintain the property to FHA standards. When she asked for specifics, they referred her back to the inspection report, the one with the damning photos of peeling paint and a cracked walkway. They informed her that because the loan was now in default, the entire balance, the original amount plus years of accumulated interest and a dizzying list of servicing fees, was now due and payable. The 90-day window wasn't a chance to fix the paint. It was a chance to come up with over $250,000. The number was so absurd, so astronomical, it was almost laughable. It was a death sentence for her life in that home. Panic set in again, cold and sharp. She realized she couldn't do this alone. She needed a lawyer. But the thought of the cost was another wave of nausea. How could she afford legal fees when she couldn't afford a painter? Her daughter, Sarah, finally coaxed the story out of her. The shame Maria felt was immense, but Sarah's reaction wasn't judgment. It was fury. She immediately started researching, calling legal aid societies and pro bono services for seniors. The first few calls were dead ends. Many organizations were swamped, underfunded, or didn't specialize in the complex niche of reverse mortgage foreclosure defense. It felt like they were shouting into a void. Finally, A referral led them to a small, cluttered office downtown. The lawyer, a man named David Chun, was in his late 50s with tired eyes that had seen too many stories like Maria's. He didn't make any grand promises. He just listened. He spread the reverse mortgage documents across his desk, the thick stack of papers Maria had signed all those years ago. Barely understanding the implications, David tapped a paragraph deep within the fine print. "Here it is," he said, his voice grim. "Section 4. Borrower's obligations. It all looks standard. You agree to pay property taxes, you agree to keep homeowners insurance, and right here, you agree to maintain the property and not allow it to deteriorate or decrease in value." "But I did," Maria insisted. "The roof is sound, the plumbing works. A little peeling paint isn't deterioration." "To you and me it isn't," David agreed. "But the contract doesn't define deterioration. It leaves that interpretation up to the lender and their appointed inspector. It's a gray area, and in a reverse mortgage, any gray area is a danger zone for the borrower. They can, and they will, use that ambiguity against you." He explained the cruel mechanics of the situation. The lender wasn't just foreclosing over a paint chip. The maintenance issue was simply the trigger, the legal key they needed to turn the lock. Once that key was turned, the contract allowed them to accelerate the loan. That meant the entire balance became due. It was a tripwire. A minor fixable issue was intentionally used to create an impossible, unfixable financial demand. "But what about the non-recourse feature?" Sarah asked, remembering the big selling point from the original loan officer. "They told us the most we could ever owe is the value of the home. They can't come after her other assets." David nodded slowly. "That's one of the most misunderstood and frankly deceptively marketed features of a reverse mortgage. Yes, it's a non-recourse loan. That means if the loan balance grows to be more than the home's value, the lender can't sue your mother's estate for the difference. It protects her savings, her car, any other assets." He leaned forward, making sure they understood the next part. "But it does absolutely nothing to protect the home itself. In fact, it's the opposite. The lender has no interest in her other assets. The only asset they are concerned with is the house. The non-recourse clause protects your mother's bank account, but it gives the lender a green light to seize the one thing she cares about most. They get the house, sell it, and satisfy the debt. To them, it's just a business transaction." The room was silent. The protection they had been sold on was a mirage. It was a shield that protected everything except what was actually under attack. "So what are our options?" Maria asked, her voice barely a whisper. David took a deep breath. "Legally, they are following the contract. It's a predatory contract in my opinion, but it's the one that was signed. Our best bet is not to fight them on the validity of the contract itself, but on the application of it. We can argue that the alleged deterioration is minor, or de minimis in legal terms, and does not materially impair the lender's security interest in the property. We can file for an injunction to stop the foreclosure sale while we argue this in court." A sliver of hope appeared. "So we can stop it?" "We can try," David cautioned, "but it's an uphill battle. It costs money to file these motions. Takes time. And while we're fighting, the lender will be adding their own legal fees to your loan balance, making it grow even larger. They have teams of lawyers. They're counting on you not having the resources or the stamina to fight back." He looked at Maria, his expression softening. "There is one other path, though it's not a legal one. It's financial. You can try to refinance the loan with a new lender, or secure a new mortgage to pay off the reverse mortgage balance in full." Maria's heart sank. "My husband and I paid this house off 30 years ago. I'm on a fixed income. No bank is going to give an 80-year-old woman a $250,000 loan." She was trapped. The legal path was a war of attrition she couldn't afford to wage. The financial path was a locked door for which she had no key. Every avenue seemed to lead back to the same terrifying conclusion. The 90-day clock wasn't just a countdown to eviction. It was a countdown to the end of her independent life. The lender had built the perfect trap, using her own home as the bait, and she had walked right into it. The contract she signed wasn't a safety net. It was a cage, and the door had just been slammed shut. The silence that followed the click of the phone was heavier than any sound she had ever heard. For a few minutes, Carol just sat there, the receiver still pressed to her ear, listening to the dead air. It was the sound of her future evaporating. The voice on the other end had been polite, professional, and utterly merciless. It spoke of contractual obligations, of timelines, of processes that were now, regrettably, in motion. Every word was a carefully chosen legal instrument, designed to dismantle her life with surgical precision. Her first instinct was denial. This had to be a mistake, a misunderstanding. She had made her payments, she had paid her taxes, she had kept the house in perfect order. She had done everything right. She spent the next week in a frantic haze, calling the lender back, trying to get past the customer service representatives who read from the same script. They were sorry for her situation. They understood her frustration, but the terms of the loan were clear. Her 60-day absence from the home, even for a medical emergency, constituted a breach of the occupancy requirement. The loan was now due and payable, in full. The amount they quoted her was staggering. It wasn't just the money she had received. It was that amount plus years of compounded interest, plus insurance premiums the lender had paid, plus a labyrinth of servicing fees she never knew existed. The total was now far more than the house was even worth. The concept of a non-recourse loan, which was sold to her as a primary feature of safety, now revealed its cruelest irony. Yes, the lender couldn't come after her other assets, but she had no other assets. The house was everything. The non-recourse clause didn't protect her. It protected the lender, ensuring they could seize the most valuable thing she owned without any further obligation. Desperate, she reached out for help. She called a housing counselor who listened patiently before telling her the bitter truth. Her options were limited. The contract was ironclad. She called a local legal aid society, and a young, overworked lawyer looked over her documents with a sad expression. He explained that these cases were tragically common. He pointed to the fine print, the dense paragraphs that she had skimmed over years ago, her eyes glazing over with the assurance of the loan officer that it was all standard procedure. There, in black and white, was the occupancy clause. It didn't just say she had to live there. It stipulated that the home must be her principal residence, and that any absence longer than 60 consecutive days could trigger a default. Her hospital stay, followed by the recovery at her daughter's house, had tripped a wire she never knew was there. The lawyer explained that for the lender, this wasn't personal. It was business. The property was an asset on their books. An unoccupied property is a riskier asset. Her medical crisis was, to them, nothing more than a change in the risk profile of their investment. Her son David tried to intervene. He spent hours on the phone with the lender, his voice escalating from calm negotiation to raw-throated anger. He offered to start making payments. He asked if they could modify the loan, if they could just reinstate it. The answer was always the same. The loan had been accelerated. The full balance was due. The only way to stop the foreclosure was to pay them a sum of money he simply did not have. He looked into getting a new mortgage to buy the house back from the reverse mortgage company, but the inflated loan balance made it impossible. The debt was now higher than any bank's appraisal of the home's value. They were trapped. Then the letters started coming. They were no longer from the customer service department. They were from the lender's attorneys. The language grew colder, more threatening. Notice of intent to foreclose. Demand for payment. Each envelope felt like a punch to the gut. Carol started hiding the mail from herself, letting it pile up on the kitchen counter, a monument to her fear. She felt a profound sense of shame, as if she had failed in some fundamental way. She had always been so careful, so responsible. Now, in the twilight of her life, she was being branded as a deadbeat, a failure. She began to feel like a ghost in her own home. Every object held a memory, but the memories were now tainted with the specter of loss. The armchair where she'd rocked her grandchildren to sleep, the kitchen where she'd baked thousands of cookies, the garden she had tended for 40 years. It was all being repossessed, not just financially but emotionally. Strangers started driving slowly past the house. A realtor left a business card tucked in the door. The lender was preparing to sell. The process was moving forward with a chilling bureaucratic indifference to the human life it was destroying. One afternoon, David came over and found his mother just sitting in the living room, staring at the wall. The foreclosure auction date had been set. He tried to talk to her about their options, about finding an apartment, about moving in with him. But Carol seemed distant, her spirit eroded by the relentless stress. She told him about the loan officer, the friendly man who had sat at her kitchen table all those years ago. He had called himself a retirement specialist. He had promised her peace of mind. He had sold her a dream of security, of aging in place, of tapping into her home's equity to live a more comfortable life. What he had actually sold her was a financial guillotine. held up by a thread of fine print. And her medical emergency, the very kind of crisis she thought the money would protect her from, was what severed the thread. The loan hadn't been a shield. It had been a weapon, turned against her at her most vulnerable moment. The lender wasn't a partner in her retirement. They were a predator that had been waiting patiently for her to falter. The cruelty of it was what she couldn't comprehend. The system was designed this way. It was designed to work perfectly, even if it meant leaving an 82-year-old woman homeless. It was all legal. It was all in the contract. And that, she realized, was the most terrifying part. This wasn't a scam happening in the shadows. This was a legitimate financial product approved by the government, advertised on television, and sold to millions of seniors just like her. As the auction date loomed, a certified letter arrived. It was thick and heavy with official seals. David opened it for her, his hands trembling slightly. It was the final notice, the eviction order. It stated in cold, unambiguous terms that she had 5 days to vacate the premises, 5 days to pack up a lifetime, 5 days to say goodbye to the only home she had ever known. The piece of paper didn't just represent the loss of a house. It was the formal, state-sanctioned erasure of her life within those walls. The cage door hadn't just been slammed shut. It was now being dismantled, with her still inside, and thrown out onto the street. The letter wasn't just paper. It was a verdict. But what the lender and the foreclosure machine hadn't counted on was Marjorie. And they certainly hadn't counted on her neighbors. The story, whispered from porch to porch, then amplified on a local social media group, caught fire. People who'd only ever waved to Marjorie as she tended her roses were suddenly furious on her behalf. They saw their own mothers, their own grandmothers in her predicament. They saw the house they grew up in, the street they played on, being threatened by a faceless corporation hundreds of miles away. A local news reporter picked up the story. Suddenly, the servicer wasn't dealing with just an elderly woman. They were dealing with a public relations nightmare. A young, hungry lawyer from a legal aid society took on her case pro bono, fueled by coffee and a righteous anger at the injustice of it all. He started digging. He found inconsistencies in the communication records. He found evidence that the servicer had been deliberately obtuse, making it nearly impossible for Marjorie to understand her obligations or her options. The foreclosure wasn't just a tragedy. It was potentially illegal. The fight was brutal. It consumed Marjorie's days and haunted her nights. It was a David and Goliath battle waged through depositions, motions, and endless reams of paperwork designed to exhaust and overwhelm. In the end, they reached a settlement. Marjorie didn't get to erase the reverse mortgage. The debt was too large, her resources too small. But the settlement gave her something almost as precious: time. It stipulated that she could remain in her home for the rest of her life, as a renter, with the servicer acting as her landlord. It was a bitter pill to swallow. She was now a tenant in the house she owned for 40 years. The title was gone. Her son's inheritance was gone. But her home, the four walls that held her entire life, was not. She won the battle, but the reverse mortgage had already won the war. Her story is a testament to the fact that even when you win, you can still lose almost everything. Marjorie's ordeal, and countless others like it, rips the friendly mask off the reverse mortgage and reveals the complex, often predatory machine underneath. It's not a simple financial tool. It's a binding contract that fundamentally rewrites the rules of homeownership. So let's pull all the threads together. What are the absolute critical takeaways from this entire nightmare? First, the non-borrowing spouse trap. As we saw with Marjorie, if your name is not on the loan documents as a co-borrower, your right to the home is fragile. Protections have been put in place since her loan was originated, but they are not automatic. They require you to meet specific criteria, file timely paperwork, and prove your eligibility to the loan servicer, the very entity that profits from foreclosing. Your home, your sanctuary, can be ripped away by a loophole you never even knew existed. Second, the ticking time bomb of taxes and insurance. This is the #1 reason for reverse mortgage foreclosures. It's not a suggestion, it's a covenant. You must pay your property taxes and your homeowner's insurance on time, every time. The lenders aren't lenient. They don't care if you had a medical emergency or a sudden unexpected expense. A single missed payment can start the default clock. And once it starts, it is incredibly difficult to stop. They can and will foreclose on you for a few $1,000s in arrears, even if you have hundreds of thousands of dollars in equity. Third, the relentless erosion of your equity. A reverse mortgage doesn't just give you money. It consumes your home from the inside out. The loan balance grows every single month, swelled by interest and a constant barrage of mortgage insurance premiums. It's designed to grow. The longer you live, the more you owe, and the less your family will inherit. It's an equity stripping machine, turning your most valuable asset into a disappearing resource, leaving little or nothing for your heirs. And that leads to the fourth point, the inheritance problem. The idea of passing down the family home is a cornerstone of the American dream. A reverse mortgage can turn that dream into a financial nightmare for your children. They will inherit not a home, but a debt with a deadline. They'll be forced to either pay off the entire loan balance, which is often close to the home's full market value, or sell the property, often in a hurry. The cherished family home becomes a complicated and stressful real estate transaction. Finally, there's the reality of the loan servicers. These are not your friendly neighborhood bankers. They are massive, often detached, financial institutions whose primary obligation is to their investors, not to you. As Marjorie discovered, navigating their bureaucracy can feel like screaming into a void. Getting a straight answer is a challenge. Getting compassion is nearly impossible. So, if this product is so fraught with risk, what are the alternatives? What can you do if you're a senior who is house rich but cash poor? The most straightforward, though emotionally difficult, option is downsizing. Selling a large family home that's expensive to maintain and moving into a smaller, more manageable condo or house isn't admitting defeat. It's a strategic financial decision. It allows you to unlock all of your home's equity, tax-free, and use that capital to fund your retirement on your own terms, without going into debt. It's trading yard work for freedom, property taxes for peace of mind. Another option is a home equity line of credit or HELOC. A HELOC also allows you to borrow against your home's equity, but it works very differently. You have to make monthly payments of at least the interest, which keeps the loan balance from ballooning out of control. It requires financial discipline, but it preserves your equity and keeps you in the driver's seat. It's a loan, not a slow-motion sale of your home to a bank. You can also look into state and local programs. Many counties and municipalities have special programs to help seniors defer property taxes or get low-interest loans for home repairs. These programs are designed to help you stay in your home, not to profit from your equity. A quick search for property tax assistance for seniors in your county can open up a world of possibilities you didn't know existed. But the single most important action you can take, before you even think about signing a single piece of paper, is to seek truly independent counsel. A reverse mortgage requires mandatory counseling, but that counseling is often a box-checking exercise. You need to talk to a fee-only financial advisor who has no stake in your decision. You need to talk to an elder care attorney. You need to have a deep, honest conversation with your children or heirs about their expectations and your needs. Do not rely on the promises of the salesperson on your television or the slick marketing materials that arrive in your mailbox. Those are designed to sell you a product, not to secure your future. They will always highlight the dream and hide the nightmare in the fine print. The story of the American home is a story of security, of legacy, of a place to build a life and a family. A reverse mortgage can be a tool that perverts that story. It can turn your greatest asset into your greatest liability. It can turn a symbol of independence into a financial cage. Marjorie's story ended not with a triumphant victory, but with a weary truce. She kept her home but lost her ownership. She held on but at a tremendous cost. Her struggle should serve as a warning for all of us. Before you invite this complex financial product into your life, you must understand every single risk. You must read every line of the fine print. You must ask the hard questions and demand clear answers. Protect your home. Protect your legacy. Protect your peace of mind. Because once you sign on that dotted line, you are no longer just a homeowner. You are a borrower in a very complicated and often unforgiving game. And it's a game where the house, in more ways than one, always has the advantage.